Now that we've described the two types of entries, the confirmation and double confirmation entry, you might be wondering, when do I look to trade from the extreme or the decisional? We discussed either situation for both the double confirmation and confirmation entry, but I'm a little confused. Let's talk about that. So after establishing whether to use a double confirmation or confirmation entry, the next step is to determine which level to enter on. There are two different levels to enter on, the extreme level or the decisional level. When deciding whether to enter on the extreme level or the decisional level, the biggest factor is where liquidity has been built and swept in relation to both of those levels. Having a focus on liquidity interaction will provide further context that we can use to select an entry area. There is no definitive conclusion on whether or not to use one level over the other, but these criteria provide us with strong confluences and guidelines to approach an entry at either the extreme or decisional levels. Also, this emphasis and focus on a repeatable process is what's going to help us make our trading simplified. So let's first talk about extreme entries. An extreme level can be used to enter the market in two ways. If neither the extreme or the decisional level sweeps liquidity, or if the extreme sweeps liquidity but no decisional level exists within that structural leg. If no liquidity has been taken, the best area to look for an entry will be the extreme, because decisional levels will likely be used as that liquidity. An extreme level will always be the best place to enter, as it's the best possible price to enter within that structural range. However, price does not always return to it. So let's take a look at extreme entries, and there'll be two different types that we'll be referring to: the reversal extreme entry and a continuation extreme entry. And this will just factor in whether we are trading with the trend or if we're starting to trade against the trend, or if the trend is potentially switching. So if we take a look at this first example, we can see that no liquidity has been taken by the extreme. So the zone is swept and traded from. So what we can see is price creates a low, we trade higher, creating a change in character. We start to see the last point of supply fail, creates our tradable zone, and price trades down in. We sweep or just trade slightly below the zone itself and then trade higher. And in this case, because the extreme didn't take any liquidity, the extreme itself was used as the liquidity. Another example that we can take a look at is a supply to demand zone flip, or in this case, a decisional level is created. So as we can see, price trades lower, we trade into the last point of supply, price creates that initial reaction, the extreme of the reaction leg, the failure of that zone, and we create a supply to demand zone flip, which creates structural and reactionary liquidity. Price then trades lower, sweeping that flip, taking the liquidity and trading into the extreme. And if we take the flip side, just to take a look at supply or selling situations, we can see that we create a high, we start to break the last point of demand, trade lower, creating that change of character and that potential shift in order flow. The extreme has not taken liquidity, therefore the extreme could very well likely be taken as liquidity, and also see the extreme hold and trade lower. Another example where the decisional becomes the liquidity, we can see that the extreme has not taken liquidity, and we have price creating a high, we trade down into the last point of demand, gives a reaction, our initial reaction, our extreme of the reaction leg, and the failure, we've seen the last point of demand fail. We're anticipating that because the extreme has not taken liquidity, the decisional or this demand to supply flip zone will be in fact used as liquidity to trade into the extreme and to then trade lower. Now, one thing to note here is that while we have an entry zone marked at each of these extreme zones, this methodology and this way of thinking can also be applied to double confirmation entries for your first level of respect zone as well. Now let's pivot into continuation entries just to take a look at the market continuing on. Now, if we take a look at this continuation example, we can see that the extreme takes liquidity and no decisional is present. So as we can see, we create this bit of structural liquidity. Price creates these internal highs, breaking higher, then we trade down below, sweeping the liquidity and then trading to the upside, causing that last point of supply to fail and price to continue making a higher high. We now have a tradable demand level at the extreme that has taken liquidity. Another example would be the supply to demand zone flip does not sweep liquidity, therefore is more likely to be used as structural liquidity. So just Put simply, the decisional is used as liquidity. We can see that price is creating a higher low, creates our last point of supply level. Price trades into that supply level, initial reaction, extreme of the reaction leg, the failure. We've seen the last point of supply fail, a supply to demand zone level created. Price then trades lower, sweeping the flip or sweeping the structural liquidity of the decisional level, trading into the extreme to then trade higher. Now, the final example that we can take a look at is the supply to demand zone flip decisional level does not sweep liquidity and therefore is more than likely used to be swept as structural liquidity. And the extreme is also part of a demand chain. So what we can see is price creates demand here, price creates a higher high, price trades back into demand, price then trades higher, reacting off of the last point of supply, initial reaction, extreme of the reaction leg, the failure of that last point of supply. Since the extreme has not taken liquidity, we can gauge that the decisional is likely to be swept and used as liquidity to trade into the extreme demand zone and trade higher. And what you'll notice is as we've been going through this, we've also been using our POI selection and confluences to strengthen the zones that we're talking about, whether we have liquidity points of interest and extremes, we have demand chains and extreme levels of demand to trade from. Using all of these things in conjunction is going to create higher probability points of interest, especially when we pair them with confirmation, double confirmation entries, and knowing whether to trade from the extreme or the decisional levels. Now let's just take a quick look at the supply level continuation entries. And similarly, we can see that the extreme takes liquidity and no decisional is present within the leg. So we would trade the extreme. So we can see as we start to create lower lows and then trade higher, taking the liquidity above this high, and then we trade lower, causing the last point of demand to fail, putting in a new lower low, creating our supply level. Now, whether this is a first level of respect supply level or a tradable supply level will again depend on whether or not you are looking at a confirmation or double confirmation entry. Another example, the demand supply flip zone or decisional level does not sweep any liquidity and therefore is more than likely used as structural liquidity. As we can see, price creates a demand level to create our pullback. We trade lower into the last point of demand, get our initial reaction, our extreme of the reaction leg, the zone fails, our last point of demand fails, and then price trades up, taking the flip or the decisional level as liquidity because the extreme hasn't taken liquidity, taps into the level of supply and then continues to trade lower. And the final example is the demand supply flip zone or the decisional level does not sweep liquidity and therefore is more than likely to be used as structural liquidity, and also because the extreme has not swept liquidity. The extreme is also part of a supply chain. So as we can see, we create a supply level, we trade lower, price runs into supply, we trade lower, we interact with the last point of demand, creating our initial reaction, our extreme of the reaction leg, and the failure. Because the extreme has not taken any liquidity, we're anticipating that the decisional level, this demand to supply flip, will be used as the liquidity for price to trade into the extreme and trade lower. This POI has higher quality because it is part of a supply chain as well as trading from the extreme. Now let's dive into decisional entries. A decisional level can be used to enter the market in two ways: if the extreme sweeps liquidity or if the decisional level itself sweeps liquidity. In these situations, the decisional level can be focused on because liquidity has been factored into the setup and should fuel the move in the market. Even if all the criteria are met, the market may still go back to the extreme level and ignore the decisional level. The market can still use the decisional level as additional liquidity to fuel the move, as there may have not been enough liquidity swept in the market to properly fuel the move. Now let's take a look at the two different examples or types of decisional entries, the reversal entries and the continuation entries. And as we can see, if I draw this on a little bit more implicitly, we have a bearish trend likely interacting with a higher time frame level of demand. And what we can see is we create our lower low, price trades into the last point of supply. If price is to continue trading lower, we would see price react off of supply and continue to trade lower. But because we've interacted with a higher time frame level of demand, price reacts off of the last point of supply, our initial reaction, our extreme of the reaction leg, and the failure. We can then see after the last point of supply has failed, price trades lower than the previous reactionary structural liquidity flip area and then continues to trade higher. So the supply to demand zone flip builds and sweeps structural liquidity. Therefore, we can look to trade the decisional flip level. Another example that we can look at is price trades lower. We react off of a higher time frame point of demand. Price then trades into a level of supply, trades lower, takes out the initial reaction, and then trades lower. This would be a reactionary sweep. And what we can see is price then trades higher, seeing the last point of supply fail. This is a key point to form our actual demand zone that we would be looking to trade from. But because the reactionary portion of this supply zone has been swept, it has created a tradable zone at the decisional level. Now let's take a look at supply situations based on reversal entries at the decisional zone. And what we can see is price is creating higher highs and higher lows and is trading into a higher time frame level of supply. When price interacts with this higher time frame level of supply, we see a reaction trading into the last point of demand. This last point of demand gives a reaction, our initial reaction, our extreme of the reaction leg, and the failure. We have now seen the last point of demand fail. We're starting to see order flow shift. Price then trades higher above the previous swing high of the extreme of the reaction leg, and then trades lower. What we can see from that is that price has taken the structural liquidity that was created from the extreme of the reaction leg and created a tradable supply level. And because this extreme of reaction leg was swept as liquidity, we are able to trade from the decisional level as it has swept liquidity. Another example is we have price interacting with a level of higher time frame supply. We come down into the last point of demand, give a reaction, the initial reaction, the extreme of the reaction leg. We see the failure of the initial reaction, and then price trades higher, sweeping the extreme of the reaction leg, and then trading lower, causing the last point of demand to fail. The key thing to note, besides the fact that we've swept liquidity, is also that the last point of demand has actually failed. Once this last point of demand has failed, it creates our tradable zone. We're able to trade from the decision level because we took out the extreme of the reaction leg and used it as liquidity. So the decisional has in fact taken liquidity. Now let's look at continuation entries using a decisional level. A continuation entry would be, as you would expect, prices continuing on in the markets, creating lower lows and lower highs. And as we can see, price forms a low, forms a lower high, forms a lower low, and then price trades above. So the extreme has taken the liquidity and has now traded into the last point of demand, given the initial reaction, the extreme of the reaction leg, and then the failure of that last point of demand. Because the extreme has taken liquidity, we are able to trade from the decisional level, which is a supply to demand zone flip. Another example that we can use is that the extreme takes liquidity and forms a supply chain. So as we can see, price is in a bearish trend. We're creating lower lows and lower highs. Price creates our lower low. Price trades higher, taking out the previous lower high, sweeps it as liquidity, trades down into the last point of demand. Price then trades into the previous supply that was in this otherwise higher high, this sweep here. And the key here is now we see the last point of demand fail. We need to see this last point of demand fail to confirm that this in fact was a sweep. And now that we've seen price trade lower and break the last point of demand, we can trade this more decisional level. The reason it would be considered a decisional level is because the extreme would still be present in this portion. As if we were looking at our market structure, we would be using this previous higher low and this lower low as our structural range. And because the extreme took liquidity, we're able to trade from the decisional level. Now let's take a look at the flip side and looking at demand entries at decisional levels for continuation entries. And similarly, we're seeing the market putting in higher highs and higher lows in a bullish trend. So we form a high, we form a higher low, we form a higher high. Price then comes, sweeps below the previous higher low, and then trades up into the last point of supply, gives an initial reaction, an extreme of the reaction leg, and causes the last point of supply to fail. A key here is that the last point of supply fails, and now we can gain that the extreme has swept structural liquidity, and we're able to trade from this supply to demand zone flip decisional level. And then a final example, similarly, we have a bullish example where we are trending, making higher highs and higher lows. Price creates a higher high. We pull back, taking out the previous higher low, sweeping below it. Price then trades higher, trading into the last point of supply, gives a reaction. This reaction trades into the extreme, which causes the last point of supply to truly fail, forming our higher high. Again, this is an important key thing to note here, that our last point of supply has in fact failed, to confirm that this was truly a sweep of structural liquidity. And because of this and the fact that the extreme has taken liquidity, we are able to trade from a decisional level. And again, this is a decisional level because if we're looking at a bullish structural range, we would be using this higher low and this higher high to warrant our structural range for this bullish situation. And as you can see, this is a very powerful lesson in understanding whether to trade from the extreme or the decisional level. All these situations can be used when you're looking at confirmation entries in terms of whether you want to take your trade from an extreme or a decisional level. And we can also use this information on a double confirmation entry to establish our first level of respect, because the first level of respect can also form at an extreme or a decisional level based on these confluences. And on top of that, we can use this information to gauge whether or not we're actually going to enter our double confirmation entry on an extreme or a decisional level. Because if we're looking at our double confirmation entry, our floor component of the double confirmation could be at an extreme or a decisional level. So let's use an extreme level for an example, is what establishes our first level of respect. And when we're looking at our tradable zone or execution zone on that double confirmation entry, it can be on an extreme or a decisional level. So we could see a first level of respect on an extreme zone and execute based on a decisional level. So these things are very important to take note of and implement into your trading.